It seems like everyone wants to beat the market. In fact, there are entire industries dedicated to the pursuit of above-market returns. The S&P 500 averages an 8 to 10% return per year. Yet that's not enough of a return for some people. And if you want to get rich fast, people say you have to make more than 10% every single year. Think about when you turn on the TV and you go to CNBC. You might have the Jim Cramers of the world selling you stock picks. Then you turn on the computer, and you might see a motley fool type of publication trying to sell you a subscription service for their premium stock analysis. Then there's a subreddit community of Wall Street bets where people are posting their gains and losses in the attempt to try to beat the market and YOLO their way into higher net worth. And it seems like no matter where you look, you could find some confirmation for any stock idea that you have. And so many people are just obsessed with this notion of beating the market. In this video, I'm going to share with you psychological biases that are hardwired into every investor's brain, which not only explain why we keep trying to beat the market, but why we're actually destined to fail at it. I'm going to share with you some case studies on how professionals QA and even beat the market. And we'll discuss why you don't need to try beating the market, and that's actually the better way to live. To begin, let's look at the SPIVA scorecard. This is essentially a report card that grades professional fund managers, and is published by the S&P Global Company, which is the same company behind the S&P 500 itself. In this scorecard, they take thousands of actively managed mutual funds and compare the funds' returns to the market index like the S&P 500, and they also track this over different time periods. If we look at this column chart, even in a relatively good period like the first half of this year of 2025, 54% of active funds still could unbeat the S&P 500. That S actually kind of on the lower end as well. As you can see, most of the time it is over 50% that funds will underperform the S&P 500. You have some outlier years here and there, like in 2007 when 45% of large cap funds underperformed the S&P 500, but still 45% is quite a lot. But that's not the glaring problem. If you actually scroll down in the report, you can actually look at the performance of all of these funds across different time periods. As the time horizon gets longer, you'll notice that after 1 year, 3 years, 5 years, even up to 20 years, the percentage of US funds underperforming their benchmarks gets worse and worse every time. For all large cap funds compared to the S&P 500, you'll notice that by the time the 10-year time frame rolls around, 85.98% of large cap funds underperform the benchmark. By the 20-year mark, that is now 91% of funds underperforming their corresponding benchmark. So these are professionals too, with a lot of resources. Warren Buffett was so confident in this reality that he made a public $1 million bet against some of the world's most elite hedge funds. He bet that they couldn't beat a simple index fund over a 10-year period. This bet ran from 2008 to 2017, with Buffett wagering that the S&P 500 would outperform a selection of hedge funds over those same 10 years. And you guessed it, the results weren't even close. As of the end of the bet, Buffett's S&P 500 index fund had compounded a 7.1% annual gain over that period of 10 years. The basket of funds selected by Protege Partners, the managers with whom he had made the bet, had gained 2.1%. The hedge funds underperformed the S&P 500 every single year, with the exception of 2008, where the hedge fund was just down a lot less than the S&P 500 was for that year itself. What's also funny is that while hedge funds can be down in performance, the hedge fund itself can be doing well financially because it charges annual fees to its investors. In conceding defeat, Saad's the hedge fund manager who wagered the bet with Buffett, said the high investor fees charged by hedge funds were a critical factor. Hedge funds tend to be a good deal for the people who run them, who pass on the big bills to their investors. So hedge funds tend to charge a 2 and 20. It's model a 2% management fee on assets under management and a 20% fee on profits every year. And just to illustrate how big of a fee a 2% fee is, we can look at this chart from Investopedia, which details the small differences of expense ratio fees. Even seemingly small percentages make a big difference over time when it comes to your returns. This drives home the point that even professionals can't beat the market. So if that's the case, where elite hedge funds can't beat a simple index, why do people keep trying? The answer isn't rational, it's psychological. There are powerful cognitive biases that make us believe we can be the exception, even when the data proves otherwise. The first of these cognitive biases is what's known as the disposition effect. This is where investors consistently sell winning stocks too early and hold losing stocks for way too long. Studies have shown that winning stocks sold too early went on to outperform the market by 2.4%, while the losing stocks held by these same investors underperformed by 1% or more. This disposition effect is a combination of regret, avoidance, and loss aversion. With regret avoidance, you don't want to regret not taking profits, so you sell early. With loss aversion, you're unwilling to realize a loss, so you hold on, hoping it'll recover, sometimes from being down 20%, 50%, or more. Macro Synergy, a London-based macroeconomic research firm, also found that this effect is amplified during market crashes. When markets are doing poorly, people become even more likely to panic and sell their winners while holding their losers for too long. The next case study shows how emotions can actually drive market behavior and lead to poor investment decisions, especially if you're a retail investor. Earlier this year, 3 researchers from Ireland and Australia studied the GameStop situation that unfolded back in 2021. And they discovered that they could predict the stock's price movements by analyzing emotions and sentiment expressed in Reddit posts. This was on about fundamentals or earnings. It was pure psychology driving billions of dollars in stock value. According to them, there were 3 phases of emotions: joy, fear, and anger. When users expressed joy and excitement, GameStop's price tended to rise shortly after. Once fear set in, prices dropped. After the crash, anger led to doubling down, briefly pushing prices back up. At some point, GameStop traded purely on mania. Modern retail investing, amplified by social media, can be dangerous because it creates feedback loops where emotions drive stock prices. The third psychological tendency is overconfidence bias. A study of 66,000 brokerage accounts found that the most active traders, the most confident ones, underperformed the market by 6.5% annually. The study concluded that the average household underperformed the market by 1.5% annually and turned over 75% of their portfolio each year to 25% more than the market. When you factor in fees and commissions, those kill returns. People trade too much because they're overconfident in their stock-picking abilities. Even if they can technically beat the market, they still have to beat the costs of trading, and that's very difficult. So everything about the failing fund managers, psychological biases, and emotions in trading actually leads to good news. You can stop playing that game and stick to a strategy that works. Look at the S&P 500 over the past century, through the Great Depression, World War II, the dot-com crash, 2008 financial crisis, and COVID-19. The market has delivered consistent wealth to patient investors. The average annual return still sits around 10% over the long term. The more simple your life can be, the better. When you stop trying to beat the market, you gain peace of mind, and paradoxically, better returns than most people. Practically, this means buying a low-cost index fund like VTI or VO, and just setting it and forgetting it. Could invest in a 3-fund portfolio: a U.S. stock market index fund, an international stock market index fund, and a bond market fund. Or focus on optimizing where your money goes. Contribute to your Roth IRA or 401k. Diversify with real estate or commodities, or hold a few great companies for the long term. Essentially, you profit off other people's psychological mistakes. Every time someone panic sells or tries to time the market, their loss becomes your gain, because you're not even playing that game.